Hello and welcome from Trend Signal for our review of the data and events the week beginning the 12th of January 2015, the second full week of the trading year. The big data week of the month is already out of the way with last week's plethora of data. Just compare that with this week's. This is last week, so a significant amount of data last week. This week we have a lot fewer to upset the apple cart, as it were. Let's just have a look at what's gone on over last week. Market seems to be focusing on oil and its deflationary effects and the effects it's having on big oil exporting countries such as Russia, Venezuela, Mexico, etc. And I guess the risks of a Russian default have probably increased this year. We've also had some fairly weak CPI data, or what used to be called inflation data. Perhaps it should be renamed deflation data. We got a minus number in the Eurozone. Prices fell 0.2%. This is the first reading, or the flash estimates of CPI data in the Eurozone in December, which means it's official. The Eurozone is in deflation. The initial reaction was to see bond markets rally quite sharply as yields fell. But actually the euro did end up the week rallying last week. I guess a relief rally, you could say, perhaps in part because of a report, I think on Bloomberg, that any proposed Eurozone QE, or quantitative easing, by the European Central Bank will be less than participants are looking for. Bloomberg suggested 500 billion, which excludes Greek bonds. I think the problem for the ECB, because it really only wants to buy investment grade bonds, will have to include some sovereign bonds that are not AAA rated, I guess. I suppose the ECB perhaps should take note of the market reaction and ensure the amount is what the market wants or expects. I somehow feel that's unlikely with the European Central Bank, though. So the big event really last week was our non-farm payroll, or what we over in the UK refer to as unemployment, regular unemployment data. That came and went, a very good number, beating consensus, confirming 2014 as the best year for job creation since 1999, which is contrast sharply with the Eurozone. And US unemployment rate in December, that fell from 5.8 to 5.6%, certainly ahead of predictions of 5.7%. But really, in a week when it seems the whole investing community is focused on falling oil price and, as we've just mentioned, the risk of deflation, a component of the non-farm employment report was that was worrying traders and investors was the average hourly earnings, and it's worth looking at on Forex Factory. It doesn't actually show up on the high impact data, but if we just put on the medium impact data, we can see the average hourly earnings here, which on its own is not really followed that closely. But what was interesting, it's actually dropped 2.2% from November to increase just 1.7% over the previous 12 months. This had the effect of pushing bond yields lower again on Friday and upsetting the stock market a little bit. And I think that also undermined the dollar to a certain extent. As I said at the beginning of this piece, that perhaps there's a little bit of profit taking in the US dollar, but some traders were now pushing back expectations of the first rate increase in the United States, some predicting it as early as April, but that becomes less possible as we see inflationary or non-inflationary data coming out, such as the average hourly earnings component of the non-farm payroll report yesterday, on Friday, I should say. So really last week, as I say, stock markets slipped. The FTSE, S&P, Dow all fell between 0.5% and 0.75%. German DAX was quite weak last week, but obviously we've started the week this week with a sharp rebound in equities, and expectations from some quarters that we're going to see new highs in the US. It certainly seems, as always, as it has been the case over the last few years, that the Fed seems to be trading the equity markets on the long side, and each time we see a sell-off, there is a pretty sharp rebound. And one could say perhaps that the Fed are trying to avoid what happened in the 30s in the last century after the Great Depression by tightening rates too soon, which sparked a slump straight after they tightened. So that's something the Federal Reserve in 2015 are trying to make sure they don't repeat mistakes of the past. Events, data and events this week. Let's just go back to the high impact ones and focus on those. As you can see, it's a relatively quiet week. It's coming of age holiday in Japan on Monday, so markets are shut. We have our inflation data in the UK on Tuesday at 9:30. Another fall. Wow, that's a big change in over a year, isn't it? 0.7% now, below 1%. And following really the trajectory of inflation data in most major economies. We have a European Court of Justice ruling on Wednesday for the stability mechanism and the fiscal compact, although I don't believe there's any concern over that. Retail sales on Wednesday from the US, second most important number of the week. It's the core retail sales. We're interested in the ones that exclude food, which is a more volatile component. Thursday, two bits of inflation data out from the US this week. The first one on Thursday, which is a producer price index. That's goods and services at the factory gate, as it were. So it's the leading indicator of inflation, I guess. Very, very weak, minus 0.3% number there, obviously reflecting the sharp fall in oil, as in all inflation or deflation numbers do for the time being. The most important data on the week actually is Thursday at 3 p.m., which is the Philly Fed Manufacturing Index, the Philadelphia district. It's one of the biggest manufacturing districts, so that's watched quite closely. Prior to that, although it's not listed on here, we have the Empire State Manufacturing Index, which is the New York district. Nevertheless, manufacturing still remaining quite strong, but slipping a little bit in the month of December. Then we have the US inflation data, the second one, which is the consumer price index, and again we can see here the core data is the one again we look at, plus 0.1%. So absolutely no threat to inflation whatsoever there. Deflation more to people's to the fore really at the moment. And finally, we finish with a favorite of ours, just looking at the University of Michigan consumer sentiment. You'll note that the consumer in the US, partly courtesy of the collapse in the oil price, very confident about a number of things, I guess, job prospects and the dollar in their pockets, and the markets obviously close to all-time highs. They remain very, very confident indeed. That's it. Thanks for listening, and bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.